Warren Buffett is one of the most successful and wealthiest investors in the world, and as a consequence, many pay great attention to his words. After all, a lot of valuable knowledge can be found in his insights about finance and investment. One particular quote that I'm drawn to is, "Don't save what is left after spending, spend what is left after saving." Normally, people prioritize spending on their needs and desires, and then budget the remaining amounts for saving. What Buffett advises instead is that saving should be prioritized, and what little remains can then be spent. To oversimplify this quote, people may usually spend more than save, when they should instead save more than spend. This is easier said than done, but it is a good rule of thumb for life. From the title of the video and the general politics of my channel, many of you may guess that today's video is about how government overspending and constraining the private sector leads to detrimental results for the economy. After all, I have previously commented how windfall taxes suck, that the US government caused their baby formula shortage, that wealth taxes are notoriously inefficient, that some large-scale vanity projects can't reduce inflation, or how collectivized control can be bad for the environment. While I obviously agree with all of this video talks about a different type of overspending, particularly overspending within the private sector. But before we continue, this is my 100th video and hits on previous videos and research I have done, which all accumulates to my main argument right here. Anyway, there has been a train of thought by online progressives that spending drives the economy. Cenk Uygur of the Young Turks himself had said in his debate with Ben Shapiro that lower and middle class consumers were more likely to spend more of their money since their expenses eat up a large amount of their disposable income versus wealthy investors, so are less inclined to save. This would allegedly transfer money or resources to people like businesses to produce more goods and services, as well as higher incomes for workers, rather than that money sitting in a rich person's savings account.
So, for example, the reason why when taxes are higher, it winds up being better for the economy is because it recirculates the money. So if you give it to the rich, this is hilarious. If you're uneducated, please at least don't make it obvious. And so the way that it works is that when the middle class has more money, disposable income, they spend it. Why? Because they're not living in the lap of luxury. They're not saving it for their yacht. So they need to buy food for their family. They need education for their family. So they spend it and it goes back into the economy. If you just give it in supply side economics to the rich and hope that it trickles down on us eventually decades later, what they wind up doing with it is something that is logical. They save it. But that means it does not recirculate in the economy. And that is why when you have lower taxes, ironically, the economy does worse.
Now imagine the same logic, but with businesses. For businesses to grow and be profitable, often they would have to spend on jobs as well as research and development. This is referred to as investments, and with higher business investments come higher job creation and higher research and development, and with that comes higher economic growth overall. But this progressive argument further states that businesses should be incentivized to invest in, rather than hoarding their cash. Online progressive commentator Seder has advocated for this, but with a certain twist.
It's the gift of rape. The gift of rape.
Someone like Cenk Uygur believes providing money to low-income workers boosts consumer spending, which will stimulate the economy. In a similar fashion, Seder believes higher tax rates on income will encourage more business investment, going far as 90% of income in certain cases. You see, back in America during the 1950s, the top marginal tax rate for a person's income was a whopping 90%. And, well, I will let Mr. Seder explain.
And in terms of it being in favor of the capitalists, I would also change our tax policy. So, I would claw some of that back, quite a bit of it back.
What would you do?
I would return to the tax policy when we had the greatest, sort of the widest economic expansion shared by more people as a percentage of our population than any other time in this country, which was in the 50s and the 60s. And I would return to the tax rates more or less there. So your top tax rate at that time was 90%, top marginal rate, for every dollar over $470,000 you would earn. So that would be equivalent to around $3 million today. I think we should return to that type of tax
You want it
scheme.
to go as high as 90% at the top marginal tax
At the top marginal tax rate. So understand, that only kicks in with every dollar above $3 million.
I hear you.
So he is advocating for taxing 90% of all income earned above $3 million within the United States. But I know some of you are scratching your heads. It is commonly agreed in economics orthodoxy that high taxation discourages investment within businesses and the private sector. But Sam has taken this into account by emphasizing revenue. Here's another clip to help you clear up any common misunderstandings of Sam Seder's point, but also see why his argument seems particularly strong.
Are you on YouTube and Rumble or just YouTube?
I'm on YouTube. I think we put it on Rumble. I think we're also on Twitch, and
all over the place. Okay, so
yeah.
Let me ask you this question. If YouTube took their AdSense from 55 to 15, would you continue creating content?
Yeah.
You sure?
Sure.
You'd continue creating content?
I wasn't doing YouTube for a long time.
How do you make a living today?
I have membership. That people pay. I get ad revenue from different places.
Okay, so let's just say the membership that you get from Patreon or whoever it is, okay? What if their fees went from them keeping 5% to 60% to 90%? Would you continue creating content?
I mean, I would probably have to cut back if there was that.
Exactly.
Well, but that's only because it's such a big change.
No, because that's the part about incentive, Sam. So your audience gets to enjoy you.
I'm not saying we'll cut the revenue for these businesses. I'm saying that the amount of
you
money...
have no choice, though, because you're paying these guys. You need the revenue.
No. I'm not suggesting we cut revenue for businesses. What I am suggesting is after that revenue comes in, and we divvy up and I have my net profits, then my taxes would go up. But I will say this, like if, let's say, the taxes went up on me personally, would I stop going on YouTube? No.
So would you be able to scale it how many employees you got working for you right now?
I'm not talking about cutting revenue.
I get that.
But I'm not suggesting that we cut revenue for businesses. I'm suggesting that what is left over from revenue, if it's over $3 million that goes into the pocket of the owner of this enterprise, that $300 million and $1 gets taxed at 90 cents.
The way taxation usually works is that it is levied on profit, which is revenue minus costs, not a tax on revenue. And since business investment can be counted as a cost in the current tax regime, the value of that investment is not taxed. The tax should theoretically not discourage investment, since it would only come into effect after investment expenditures. Sam's worldview would also indicate that if there are very low taxes, businesses would have excess cash and wouldn't be bothered to spend it on investment to grow jobs and the economy. But if their profit is taxed significantly, businesses may have the mindset that they might as well spend their revenue via investment to lower their profit, and hence fall down to a nicer, lower tax bracket, since none of that investment money would be taxed. There is a problem with this line of reasoning though. Remember that Warren Buffett quote about saving at the start? Well, while it is true that some businesses need to invest, some businesses need to save up, and both of these are vital for the economy. This is because for certain businesses, they reach a certain point where they have a lack of investment opportunities. These are usually older companies. If older businesses were to invest, they may spend their valuable money on the wrong things. They may make bad or inefficient investments, which is a large waste. Basically a waste of resources. Resources that could have instead been used for more beneficial projects later along the line. Let's give an example. Imagine two companies. One is a basic startup in the tech sector. They have a lot to do, from finding new customers, learning about the market through research, developing their products, and learning new software. A lot of room for growth and investment within the tech sector. Another is an older, well-established tech company who has many customers, well-developed products, a well-known brand, and an in-depth knowledge of their market. The latter has less room to improve themselves, might only be able to make marginal improvements to their products through research and development, find it hard to find a new large source of customers, and have a limited chance of expansion within the tech sector due to their already large size. Basically less room for investments. There is less of a reason for the older company to make larger investments since they will see lower returns. After all, older mature companies are well established and have significant brand recognition with customers, but face great competition from rival businesses that affects their profitability and generally a lower growth rate than the rest of the economy. In contrast, younger companies generally have a higher growth rate than the rest of the economy. So since older companies have worse investment opportunities, they are more likely to issue dividends than younger companies. For instance, Apple is way more innovative than Coca-Cola, given that it's from the tech sector, so issues half the level of dividends as Coke, despite both being mature companies. There is empirical proof for all of this, such as from one study that looked at the differences between older companies and newly listed companies which are young businesses. From 1963 to 1999, newly listed firms that didn't pay dividends had an average growth rate of 30.8% per year. Now, when you look at firms of all ages, that includes newly listed companies who didn't pay dividends, their average growth rate was 16.5%. If you understand the basics behind averages, you can basically infer that the older companies had an average growth rate of less than 16.5%, which is way less than that of the younger, newly listed companies. In addition, asset growth rates are a measure of investment opportunities. Companies that have never paid dividends, who again are more likely younger businesses, have asset growth rates of 16.5% compared to dividend-paying companies who have asset growth rates of 8.78%. If you still don't think dividend payers are bigger, then I should also point out that on average, from 1963 to 1967, the assets of dividend payers are 8 times larger than non-payers, and from 1993 to 1998, it is 13 times larger. So the TLDR of this is that younger companies have higher growth rates and higher asset growth rates / opportunities for investment, and older companies are more likely to pay dividends. Hence, investment should be left to younger companies. This concept is even more important when considering stock buybacks, a practice which Sam Seder is vehemently against.
Ledzonic says the stock buybacks coupled with the capital gains and the subsequent increase in compensation in the form of stock options to basically C-suite folks and board of directors accounts for a lot of problems that we have in terms of wealth inequality and job loss and whatnot. I mean, it's I think at some level it's even narrower than shareholders. I mean, here's this piece from Politico the other day. The Oracle Corporation CEO sold $250 million worth of shares in her company. The product development head sold $85 million. The sales came after the company announced a $12 billion share repurchase, right? So their stock values pop, and a dozen people at the company, maybe 15, the board of directors, I'm sure, they sell their stocks. Like their interests are so misaligned from the long-term health of the company, the fate of their workers, the communities they work in. They're running a cottage industry.
So companies have these things called stocks or shares, which basically represent a certain amount of ownership of these companies. For instance, if a company has 10 shares and an investor owns one of these, they own 10% of the business. Shares are issued by companies, and investors buy these because they get a certain benefit from it, like having a say on company decisions or receiving dividends as an income. Now, stock buybacks or share repurchases are companies buying back these shares from investors. The total market value of the company stays the same, but the individual share price will rise. Since the price of a share will be the market value divided by the number of shares, and the number of shares decrease. Now, why does this concern some people like, say, Sam Seder? Because of two main reasons. Supposedly the money used for stock buybacks could have instead been used for wage rises or business investments. When the price of a share rises, this is usually based on the company providing a benefit, like investment or higher market demand. But this share price rise seems artificial, and this is a major concern, as 57% of corporate savings went to stock buybacks, while only 20% went to job creation commitments. This is a type of scenario that someone like Sam Seder wants to avoid. Another is the allegedly perverse incentive, where higher share prices raises earnings per share, which increases the stock-based compensation for executives. So it appears that share buybacks are done for the executive's personal interest, over the well-being of the company and its employees. Except people like Seder are wrong. Why? Because stock buybacks can be used to invest into new companies. In fact, 96% of stock buybacks are reinvested into new companies, where they are presumably reinvested in other stocks. But remember how I said that older companies have less investment opportunities, so pay more dividends? Well, the same thing applies for stock buybacks, but to an even larger extent. Stock buybacks are like dividends, in that they are both forms of distributions that return money back to shareholders. And one reason for stock buybacks is a lack of investment opportunities and too much cash for companies. After all, 4/5 of CFOs personally say that investment opportunities are an important factor in share repurchases, and 60.6% of CFOs say that excess cash or liquid assets in the balance sheet are an important factor in share repurchases. Now note that this is just one of many factors, as only 30.3% said that other companies repurchasing their shares might indicate a lack of investment opportunities. Now you may still say, what about earnings per share? Aren't they a bad incentive for corrupt CEOs? Well, in the long term, if the money used for stock buybacks is instead used for positive net present value projects / investments, then the earnings per share would fall in the long term, because earnings per share is basically profit divided by the number of shares. Otherwise, if a company can be profitable without investments, as the latter will add no value or be wasteful, then earnings per share will increase. Now of course, earnings per share can increase if the number of shares fall due to share repurchases, but the number of shares a company owns seems arbitrary. If a company issues more shares, then the share price and earnings per share falls. But leftists don't call for more shares issued to be banned. I mean, if a company issued 100 shares at the start, but then issued 100 shares more 10 years later, diluting its stock, it is fine? But if they instead bought 50 shares back, it should be banned? Why? Regardless, I would love to elaborate more on stock buybacks, but we don't have any more time for this since this isn't the main focus of the video. So if you're interested in this topic, I'm going to make more videos on the topic in the future, so subscribe for that, as well as check out my 2 videos so far on buybacks. As you can see from the empirical data so far, Cenk and Sam's argument on overspending at the expense of saving falls flat. Speaking of Cenk Uygur, let's look at the company he owns, the Young Turks / TYT. They are an online progressive news media company that has been financially struggling.
Not to mention, TYT as a company is currently struggling financially.
And again, I can't even express how grateful we are for your support and for keeping us afloat, especially in a difficult time in media and digital media, to be specific.
So digital media is in massive trouble. Massive trouble. The fact that we have survived is near miraculous.
At what point in my career do I get to where I feel like we're safe and we're accomplished and like I don't have to fucking like lay awake at night with anxiety and stress and like anyway, whatever.
You've been lying to us for 12 years.
That's exactly right.
That's what it is.
I put myself through the hell of working in independent media so I can lie to you guys and make no money, and yeah, that's what I've been doing.
But why is that? Well, friend of the channel Stephen Michael Davis has a theory as someone who has watched TYT for years.
One of the reasons why the Young Turks are constantly begging their audience for money and why they're constantly struggling is because they want to be both a business and an activist organization at the same time. So they do all these interviews with, progressive candidates and whatnot. Those make them no money. They don't get like any views. In fact, they probably lose them money. Whereas, the stories about Kim Kardashian's camel toe is what people click on. Obviously, they don't do that type of content anymore, but they did at one point. The more salacious stuff is what people click on. But the progressive activism stuff is actually costing them a lot. And the fact that they are committed to doing that is one of the reasons why they're struggling so much.
Stephen further elaborated his speculation in a Twitter DM that they have a ton of employees, large overhead, and that they spend on pet projects that don't make them money. One would wonder why they would spend money on these pet projects if they don't grow the company and could instead save up to help themselves when they are financially struggling like right now. Granted, this is Stephen's subjective interpretation of the situation rather than concrete evidence, so I may be wrong. But I still have much larger evidence of why you have to hold back on spending and save for a rainy day. And this concept of saving is a major reason why high taxation is detrimental for companies, like the windfall tax that one of Sam Seder's assistants proposed.
I heard on Ralph Nader's podcast, they were talking about the like how if the Fed just bought the oil companies, but they were talking about the windfall profits tax.
Yeah.
And if we just did that, that would be like over $150 to every American.
I have responded to this before in much greater detail in another video response to Sam Seder on gas taxes, which is linked below if you want to watch it, and have in general made a ton of videos on windfall taxes if you're interested. But for this video, I'll be brief on the problems with windfall taxes. These taxes have generally been proposed when oil prices are high, but these oil prices are not surprising as they often have long-term increases and declines. So oil companies base their investment decisions on these price increases and decreases, even when they don't know the timing of such changes. In fact, these price changes may be accommodated by periods of economic booms and slumps for the oil company. forcing these companies to use that high profits gained during the boom years to finance their losses during the slump years. However, with a windfall tax targeted on the quickly accumulated high oil profits, oil producers will have much less to help them during periods of loss, slowing domestic investment. This effect occurred with the 1980s US windfall tax. The 1980s windfall tax lowered American oil production by 3 to 6%. Potential revenues were further cut, along with lower than expected oil prices. Another American windfall tax proposed in 2005 was estimated to hurt pensioners, as all significant retirement savings, including investments in the energy sector, at least at the time. The average retiree or worker would lose $50 to $287 per year, or $4 to $24 per month, depending on varying inflation rates and oil prices if this windfall tax was passed in 2005. And coming back to stock buybacks, this lesson of saving to finance yourself in case of future losses is very relevant with America's airline sector, or lack of it. American Airlines spent $12.9 billion on buybacks from 2014 to 2020, while the late airlines spent the same amount in the same period. Yet after COVID-19 hit, and even after $54 billion in aid was given to the airline industry, they were begging for more as they were still struggling. But the airline companies spent 96% of their cash flows on stock buybacks. These airline companies spent heavily on stock buybacks and failed to save for a rainy day. I know you might be confused by how I just defended stock buybacks but am now criticizing it right now, but I defend the concept and principle of stock buybacks. Not that all companies should do stock buybacks, or that there is no such thing as spending too much money on buybacks. For an individual company in a certain scenario, the right option might be not to spend as much on stock buybacks or none at all, to instead build up your savings rather than waste it on buybacks or inefficient investments. Because just like how TYT is struggling now, just like how the oil sector faces periodic declines in their prices, all businesses usually face cyclical periods of downturns and must learn how to save for a rainy day so they can finance their losses, which the airline companies fail to do. Even if you disregard all this, the so-called golden age of high taxation back in the 1950s is a myth. The US was able to sustain their economy as well as get away with high taxation because America was one of the few countries at the end of World War II to leave relatively unscathed.
And when you talk about top marginal tax rates in the 1950s, there are a couple of things that are worth noting. One, that was top individual marginal tax rates, not necessarily the business tax rate. We now have some of the highest corporate tax rates altogether in the industrialized world. And if you would prefer for us to destroy half of the world before we become the only country that didn't have its industrial capacity destroyed, which is what happened in the 1940s, leading to us being the only productive country on planet Earth, essentially, for the next 2 decades, I'm not with you there. I'm not really in favor of having a giant world war that destroys all industrial capacity across the West, so we're the only people who actually have the capacity to produce anything and just markets that we can provide to.
Thank you, Ben Shapiro, but I'm still not done here.
And yeah, I mean, that's the famous Reagan situation where I think it was anything over $200,000 at that point. This might have been in the 40s, that he would only do 2 movies a year because he'd get paid $100,000 per movie, and then he wouldn't even do a third movie because he would only get 10% of the revenue because he's like, fuck it, I'm not doing another movie.
Yeah.
So wouldn't that curb growth?
When Reagan started telling that story, yep. You know who he was working for when he started telling that story, right? He was going around, I think it was for working for GE, trying to convince people not to get Medicare for all. I mean, if Reagan could have gotten 3 movies or 5 movies, he would have done it. He was working with chimps. He would have been happy to do that for his career. Believe me. Believe me.
It's funny you mentioned that Reagan as an actor would be willing to do more acting work in spite of taxes, as some of the wealthiest people back in America during the 50s were not corporate executives or baseball players, but famous entertainers and Hollywood actors. People that should theoretically be affected by the extremely progressive tax system, such as Frank Sinatra, who made close to a whopping $4 million, which is worth roughly $35 million today. Yet somehow they avoided it. Why? Because they use a large variety of loopholes. For instance, Hollywood actors could buy rental properties since Congress passed a law in 1954 which allowed for accelerated depreciation on any income producing real estate. This basically meant that wealthy taxpayers could deduct from their income tax a % of their property value every year. This was even better for appreciated property values. Another exemption was pushing certain portions of your income in subsequent years. Basically, an actor making some money from a movie in 1 year can get the company to pay that total income over a period of, say, 4 years for each year, where a lower tax threshold was applied on each annual income. Though those earnings might take forever in the case of actor William Holden, not to mention the inflation problem. But if Holden wasn't paid $50,000 a year for the $2.7 million he made from a movie in 1957, and instead he received that lump sum in 1 year, then he would only be able to take $300,000 thanks to the 91% tax rate. In addition, there was an oil depreciation allowance where oil companies can cut 27.5% of their tax penalty generated by an oil well, and Hollywood actors bought ownership stake in these companies, such as 2 actors each buying a 25% share in a West Texas oil company for $40,000. They both earned $5 million each on their initial $40,000 investment, and thanks to the depletion allowance, $1.375 million was tax-free. And if your oil well turned up dry, you could deduct these losses from your taxes. Funnily enough, this happened so much that Hollywood was providing the capital for oil companies to drill wells. Another was the collapsible corporation loophole, where Hollywood stars moved their salary into the corporation since the tax rate there would be 50% instead of 90%. After the salary was paid, the corporation would go out of business. Soon, every Hollywood star, including Sinatra and Bing Crosby, took advantage of this, and some stars also sold their stock in their corporation to the movie company because the capital gains tax rate was even lower at 25%. Stuff like this didn't go unchallenged, of course, since the IRS sued Groucho Marx, arguing that the $1 million income received from an NBC show should be counted as income rather than capital gains. Unfortunately for the IRS, the courts disagreed. Congress even tried to stop the usage of collapsible corporation, but there was a loophole. If 25% of the company's income came from a different industry, then it was legit. So the Hollywood stars merged their oil business and movie business into one corporation. What is the point of high tax rates to encourage investment when the rich can use loopholes to just avoid them? Loopholes that American authorities failed to close. My last and final point is noting the so-called prosperity of the 1950s. Regardless of the economic growth in the US, there was one thing that was surprisingly common during that time: recessions. The US suffered recessions in 1949, 1953, 1958, and 1960 to 1961. 4 recessions in 12 years. Usually there is 1 recession per decade, so this is pretty unusual. Now, I'm not saying the 1950s didn't have high economic growth. The validity of that statement is in fact irrelevant to what I'm about to say. A recession is when economic growth falls for a long period, like, say, 2 quarters. The economy shrinks. There is a belief amongst the economic right that recessions happen because growth is artificially stimulated, even when the economy's resources/supply are unable to meet this. So demand overtakes supply, leading to overspending in the economy. But production can't keep up with this. The spending is unsustainable, as it leads to an overconsumption of resources. At a certain point, this is kind of realized when enough people can't keep up with their new spending commitments, whether through basic consumption or resources. When this happens, they dramatically spend less, leading to a contraction in the economy. In other words, a recession. The economic right believes government intervention could encourage overconsumption of limited resources, like lower interest rates from the Federal Reserve. But why is this important? Think back to Sam Seder's argument that higher taxes will force businesses to use more of their pre-tax income on significant investments that should theoretically help workers and grow the economy so they can avoid paying a higher tax rate on their remaining income. But also remember that I have proven that sometimes investments can be wasteful, especially for older companies, since they have less room for investments. If Sam is right, then companies that don't have good investment opportunities, like older, more established companies, will spend their money on bad investment opportunities. This wastes resources, which limits the overall supply of the economy, but demand is still stimulated through higher inefficient investment expenditures from the business. If this waste of resources happens enough times, the economy will be forced to cut back and lower their spending of money, whether it's consumption or investment, just like a recession. And since the taxes in the 50s were high, if Sam is correct in thinking that the high taxes would cause businesses to invest much more, then the 4 recessions from 1949 to 1961 could in part be caused by inefficient investments and mass wastage of resources. Not to mention that businesses couldn't easily redistribute their excess cash flows via stock buybacks, because from the 1930s to 1982, companies who did buybacks faced legal liabilities due to accusations of stock manipulation. So cash couldn't be given to the right companies who could properly invest to avoid wasteful investments. And the high taxes discourage businesses saving and force them to invest earlier at potentially the wrong times, rather than save it for more appropriate periods. These other two factors may arguably also have contributed to the 4 recessions. Regardless, this is just a theory of mine, and I don't know of any academic literature that has tested this theory, but this is way better than the arguments that Seder, Cenk, or any other progressive gives in support of high taxation, like the 1950s. Now, some of you may say that the Federal Reserve's actions contributed to these recessions, but they have acted in other recessions as well, so this isn't exclusive to the 50s. Overall, the argument that high taxation encourages more investment and economic growth doesn't stand to scrutiny, because not every company should engage in high levels of investments. That high taxation discourages larger savings that can allow for better investments, or to help save the company from an unexpected financial disaster. That it can lead to wasteful investments, and that there are better ways of redistributing excess cash flows, such as through stock buybacks, which enables new startups to increase their own investments, and that these taxes can be avoided by complex loopholes. Anyways, thanks for watching my 100th video and for over 400 subscribers. It was a joy to make, especially when drawing from my previous research on economics, windfall taxes, and stock buybacks, as well as my new research on the economy of the United States back in the 1950s. Again, if you are interested in these types of videos, please subscribe for more to get up to date on my videos, and check out the rest of my channel. Also, thank you to Stephen Michael Davis for shouting out my channel all these years. I received a big boost from him, and it has been great making his thumbnails, and I would recommend his channel. Also, I hope you enjoyed this video. If so, I would love if you would give a like and comment below. See you later, and bye.